In a world where headlines are often dominated by uncertainty and division, a recent development offers a glimmer of hope and a path towards constructive change. The United States and China, two economic powerhouses with an intricate relationship, have taken a significant step forward in their ongoing trade saga. The announcement of a 90-day easing of tariffs between the two nations was met with applause from the financial sector, sparking a rally in stocks and a collective sigh of relief from global markets weary of the protracted trade war. While the immediate effects of this tariff truce are certainly noteworthy, the underlying progress that may shape the global economic landscape for years to come has been quietly set in motion. Washington and Beijing have agreed to establish a trade consultation mechanism, a permanent bilateral platform designed to facilitate structured discussions on key economic issues such as currency policies, market access, and non-tariff barriers. This initiative, though bureaucratic in nature, holds the potential to bring about one of the most consequential shifts in international economic relations in recent memory. The introduction of this platform aligns with the insights of Stephen Miran, currently serving as the chair of the President's Council of Economic Advisors. In his comprehensive report titled A User's Guide to Restructuring the Global Trading System, Miran sheds light on the deep-rooted imbalances within the current dollar-centric model. This system locks the United States into persistent trade deficits while encouraging surplus economies like China to overproduce and underconsume. The surplus savings from these economies are often channeled into U.S. financial assets, bolstering the dollar and eroding American manufacturing in the process. The resulting economic order sees the United States functioning as a global consumer of last resort and debtor-in-chief, while countries like China face domestic stagnation despite their export-driven models. Stephen Miran refers to this predicament as a Triffin world, drawing from economist Robert Triffin's dilemma, where a national currency serving as a global reserve makes it impossible to balance domestic and international obligations. To satisfy global demand for safe assets, the U.S. must run deficits that undermine its economic stability, while surplus nations sidestep necessary reforms due to the rewards they reap from export-heavy strategies. China's property crisis and slowing growth highlight the limitations of its export model, while the United States grapples with mounting deficits, political polarization, and industrial decline. Both nations can no longer afford to ignore these systemic flaws. Although tariffs are often seen as a means to address this imbalance, they tend to be crude and counterproductive. Miran proposes a more nuanced approach, a structural recalibration that realigns currency values, discourages excessive reserve accumulation, and encourages balanced capital flows. The establishment of the U.S.-China consultation mechanism, with its focus on currency and non-tariff measures, suggests that Miran's framework is already influencing policy at the highest levels. This is more than a temporary detente. It represents a genuine effort to unwind the Bretton Woods II system and address the foundational issues of the global economic order. History has shown that unresolved economic distortions can escalate into geopolitical conflicts. The interwar period, for example, saw the failure to manage reparations and trade balances lead to a deflationary spiral in Europe, resulting in widespread unemployment, social unrest, and ultimately, war. Understanding the stakes involved, the new U.S.-China Committee matters greatly. It signals a willingness on both sides to move beyond tactical measures and engage in meaningful dialogue about structural solutions. Critics might dismiss this initiative as yet another diplomatic forum, but there is reason to believe it holds more promise. Miran's appointment to a top economic advisory post in the White House indicates that his ideas are being taken seriously. The alignment between his policy recommendations and the scope of the new committee is telling. Of course, none of this will be accomplished overnight. The imbalances we face today have developed over decades, and unwinding them will require patience and determination. However, the creation of this platform is a crucial first step. It acknowledges the real root of global trade tensions, not merely as a clash between exporters and importers, but as a distortion of incentives inherent in the architecture of international finance. The United States must seize this opportunity to push for a durable framework that restores balance, rewards domestic production, and reduces dependency abroad. This approach aligns with the principles of President Trump's art of the deal strategy, assertive in leverage, clear in desired outcomes, and focused on addressing root causes rather than superficial symptoms. As we look towards the future, this committee represents a forum where the next phase of the global economic order could be quietly drafted. America's strength abroad is intrinsically linked to its structural integrity at home, and this agreement presents a chance to begin rewriting that narrative. We'd love to hear your thoughts on this promising development. Do you believe this new platform will lead to meaningful change in the global economic order? Let us know in the comments below. And if you appreciate content that explores the optimistic potential of current events, consider subscribing to our channel and giving this video a thumbs up. Your engagement helps us bring more insightful stories to you, our valued viewers. In the end, while the headlines focused on the tariff cuts, the real story lies in the establishment of this committee, a platform poised to facilitate the drafting of a new chapter in global economic relations. America cannot remain strong abroad if it is structurally weakened at home. This agreement gives us the chance to begin rewriting that script, and that's a deal worth making.